Hey friends, it's Edwin Silié, your South Florida Realtor. So let me ask you a question. When you hear the word equity, do you think of it as a blessing or do you think of it as a mystery? Maybe something that you heard about but you're not sure what it is. Because for a lot of homeowners, equity can feel like a hidden treasure chest that you can tap into whenever you want. But the truth is this. If you use it the wrong way, that treasure chest can feel more like a trap. So today, I want to break down 10 essential tips that you can use for borrowing against your equity. I'm not just going to list them out. I want to talk through it. I just want to tell you about them. I want to make sure that you're sitting there like we're having coffee or tea or chocolate, and we're going to figure this out together. Some of these tips are about protecting yourself. Others are about maximizing opportunities, but all of them are about making sure you use your home equity well and you know how to move forward with it, not backwards. I want the home equity to be a blessing for you and not a curse. So let's get into it. Equity is simply the difference between what your home is worth and what you owe on your mortgage. That's all it is. It sounds simple, right? And it is. But here's where people get it wrong. Equity is not cash sitting in a bank account waiting for you. It's wealth, yes, but it's wealth that is tied up to your home. Think about it this way. Your home is worth $500,000 and you owe $300,000. On paper, you got $200,000 in equity, but you don't actually have that money. You don't. It's not theirs, not yours. Not until you actually sell your home or you borrow against it. And borrowing, that means debt, and debt means that you can use your home as collateral, and that means that if you default on it, your home is on the line. So when you start looking at equity through that lens, not as a free gift, but as an investment that can carry responsibilities, you approach every decision differently. Number 2, understand your borrowing options. This is where things can get confusing because there are multiple ways that you can tap into your equity. The 3 big ones are HELOC, home equity loans, and cash out refinances. Let me explain what all 3 of them are. A HELOC is a home equity line of credit. It works like a credit card, but your house is the guarantee. You don't get approved for a certain limit. You get approved for a certain limit and you can borrow against it, pay it down, and borrow again. So, kind of like what you do with your credit cards. The good part is very flexible, and that's nice. The risky part is that interest rates can go up and down, which means your payments can also go up and down. The second one is your home equity loan, and this one is more straightforward. You borrow a lump sum of money and you pay it back in fixed installments at a fixed rate. No surprises, it's predictable, steady, but not flexible. The third one is a cash out refinance, and that replaces your entire mortgage with a new one, often a bigger one, and the difference comes to you as cash. Sometimes this makes sense if the rates are low, but if the rates are higher than your current mortgage, it could cost you a lot of money over the long haul. I once knew a couple in Kendall who refinanced their home because they wanted $60,000 in cash. What they didn't realize was that they reset their mortgage another 30 years. So they already had paid 12 years on their loan, on their own mortgage. And overnight, poof, all that progress had disappeared. That's why you can't just jump at what sounds easy. You have to understand what you're signing up for. The third one is that you have to watch the interest rates closely. Interest rates can make or break your decision. A loan that looks affordable today can feel impossible tomorrow if rates rises. Be careful. Take a HELOC, for example. Many start with what's called a teaser rate, which is super low, it's attractive, but that rate can often adjust. I know a family in Color Bay who opened a HELOC when the rates were very low, and they were paying about $250 a month. 2 years later, when interest rates climbed, that payment went from $250 to over $500 a month. That's a $300 swing in their budget, and that hurts, especially when you don't plan for it. The lesson I learned, don't just ask what the payment is today. You have to know what the payment is going to be in 2 years, or what payment is going to be if the rates go up 2%, or if the rates go up 4%. You must know that. And if the answer makes you nervous, you might want to stick with something that is fixed, something that's not going to change. That might be a better option for you. Number 4, make sure that you don't max out your equity. Here's a trap. I see too many people just fall into it, and they fall into this trap. Just be careful with it. The bank tells you that you can only borrow 80 or 85% of your home value. And suddenly, that number feels like a target. But remember, the bank's job is to lend money. Their job is to make money. They make money when you borrow more. So that doesn't mean that it is in your best interest to borrow the entire amount that you're allowed to borrow. Let's go back to the $500,000 home that I talked about before. Say you owe $300,000 and you have $200,000 in equity. The bank says, well, you can borrow $125,000 off of that. And that sounds amazing, right? $125,000. But if you get bogged down with something, if life happens, if the market dips just 10 or 15%, suddenly you don't have much equity left. And if you had to sell, you could be underwater, owing more than your home is worth. The smarter move, only borrow what you need, what you truly need, and leave yourself some breathing room. Keep equity in your home as a safety net. You really want that. Number 5, borrow for growth, not lifestyle. What do I mean? Here's where I really want to lean in, and I'm pausing on purpose because this is important. Using your equity should be about creating long-term value, not just short-term pleasure. I knew a homeowner who pulled $40,000 of the equity just to buy a luxury SUV. It feels great at first. They were driving around in style, but 10 years later, the SUV was gone and they were still paying off the debt. That's not wealth, that's waste. You don't want that. On the flip side, I've seen families that use their equity to add a rental unit to their property, or redo a kitchen, or buy their first investment property. That $40,000 not only improves their lifestyle, but it also increases the value of their home and even generate income. One choice put money back into their pocket, the other drained it. Be careful, you know which one is the one you should make. So every time you think about borrowing, ask yourself, is this a decision that's going to help me grow or just help me feel good right now? Hey friend, I know I'm interrupting your video and I know you're enjoying it because you made it this far, and I just want to say thank you. Thank you for enjoying the video. Thank you for watching the video. Please, if you haven't done so, please hit the like button. Please subscribe and share it. Share it with your family, with your friends, with anybody that you think it will create value to their lives. Outside of that, if you need any help with a realtor, if you need any help in South Florida or pretty much any part in the United States, we have a vast amount of connections everywhere that we work with that will help you no matter where you live and where you're at. So once again, please subscribe, please share, please comment, please like. I would highly, highly appreciate it. Thank you. Take care and God bless. Number 6, don't forget the tax rules. Here's something people forget. Not every use of equity qualifies for a tax deduction. Before 2018, almost all the home equity interest rate was deductible, but not anymore. Today, the IRS says you can only deduct the interest if the loan is used to buy, build, or substantially improve your home. That means putting in a new roof, remodeling a bathroom, adding a bedroom. If you're using equity to pay off credit cards or student loans, don't expect a tax break. This one change alone has caught a lot of homeowners off guard. My advice, always run your plan by a CPA before you borrow. This is important. Have a CPA to be part of your team. Number 7, avoid over leveraging yourself. Markets go up, but they also go down. And when they go down, over leveraged homes are the first to feel the pain. Make sure that that one is not yours. I remember during 2008 housing, the crash that happened at that time, there were so many families that had borrowed every dollar of the equity. When a home price dropped, they owed more than their house was worth. They couldn't sell, they couldn't refinance, and in many cases, they ended up facing foreclosure. I don't say that to scare you. I say it because history is a teacher. The key is to borrow conservatively. Protect your financial cushion so that if the market shifts, you still have room to breathe. Number 8, think about the monthly payments. This one seems simple, but is one of the biggest mistakes that people make. They see a $50,000 loan and they think all the things that they could do with it. What they don't think about is the $400 or $500 monthly payment that comes with it. I have sat with families who were so excited about the lump sum, but then the reality hit. The extra payment became the stress point in their budget every single month. It's like bringing home a shiny new toy that quickly becomes a burden. You don't want that to be your case. So before you borrow, before you go all out, plug that payment into your budget. And if it doesn't fit comfortably, if it's going to squeeze every penny out of every month, just don't force it. Don't do it. Be patient. Remember that real estate is a long game, not a short race. Number 9, just plan for the unexpected. Life doesn't always go according to plan. Jobs are lost, medical emergencies happen, and those loan payments don't just stop, they keep coming. I once knew a teacher here in Homestead who took out a HELOC to make some much needed home repairs. Shortly after, she had to step back from her job for health reasons, and without her paycheck, those HELOC payments became impossible to manage, and it almost cost her her home. Don't let that be your case. That's why I always encourage people to have a financial cushion, 3 to 6 months of expenses. You really want that before taking any new debt. Equity can be a blessing, but if you don't prepare, it can become a burden. Don't let that be a burden for you. Number 10, just don't go it alone. And here's the final piece of advice. Don't try to navigate this by yourself. Google can give you information, sure. ChatGPT can give you a lot of information, of course, but it can't give you wisdom. And sometimes wisdom only comes from experience. So friends can share their experiences, but their situations might not match yours. This is why having the right team makes all the difference. A trusted realtor, this is important in order to help you see the big picture. A lender who will lay out the pros and the cons clearly. And sometimes, even if you can afford it, a financial advisor who can connect all the dots for your future plans and your finances. So surround yourself with voices and people that really want to see you win, not somebody who want to just take money out of your pocket. So those are my 10 essential tips for borrowing against your equity. Here's the bottom line. Your home is one of the most powerful wealth building tools you ever own. But like any tool, it can either build your future or break it. It really depends how you use it. So in this video, if it gave you any kind of clarity, go ahead and hit the like button, subscribe to the channel, and share with your friends that own homes that are also thinking about tapping into their equity. And remember, my team and I are here to serve you. If this video helped, also go check out this other video that I did on President Trump's plan to expand the mortgage system and allow for 50-year loan mortgages. And let me tell you what I think about it. So let's continue the conversation over there. And remember, as always, God loves you, and so do I. Take care. God bless.